Welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest, Andrew Falde. Before we get started, a quick disclaimer: the Capital Discussion is not a broker-dealer or investment advisor. This presentation is for educational purposes only. You don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And this is for educational purposes only. So with that out of the way, welcome back, Andrew. It's always nice to have you on the roundtable.
Thank you very much.
I'm sure this presentation will be very interesting. Everybody wants a nice, smooth equity growth curve, right?
Well, at least I got people to show up, so we'll see if I no.
There we go.
Yeah. So let me find which screen. There we go. Found it. Yeah, I'm excited about this topic too, and I hope it will be valuable. It's going to be a little bit non-traditional because I'm not going to show a trade profile that I put on and managed based on a set of rules, but I hope these concepts will be seen as valuable and maybe inspire some additional layers of thinking about options trading. So I think I got the right one here.
Okay, see it coming up. There we go. How to create a smoother equity curve. Perfect.
Yeah. That was the title, right? I just typed it in for memory.
Yeah.
So okay, good. All right. So my name is Andrew Falde. There's a rumor going around that my last name is Falde, and that's okay too. If you say it, I'll probably respond and know who you're talking about. But just wanted to share that real quick. Somebody said you should just tell people if they're saying it wrong. And okay, I'll do that. So I manage capital for a hedge fund and some separately managed accounts. And I also help with the SMBU and SMB training firm, which is an education group for trading based out of New York City. And let's get this thing moving here. Okay, so very similar disclaimers for SMB training and myself as well. So the first thing I wanted to share was I've done a lot of presentations over the years, and I think at some point it's valuable to say, I'm not a professional backtester, and I'm not a professional theoretician, if that's a word, and I'm not my primary career is not teaching about options. My first and foremost job is to trade options, to do it profitably for the people that have trusted their capital under my control, and I do have positive results from my style of trading options, which is very similar and includes a lot of the components that are discussed in the capital discussions community and as well as the options tribe community, but I'm going to share a few of the differences to my trading. So this is just a collective equity curve for the last couple of years for my style of trading, which has undergone some variation and modification, just like everybody's trading should. The best traders I know at SMB in New York, they are not static in their trading. They're not static in what they expect is going to work for them and what's going to work in current market environments. So it's actually a good thing to look back and see how your trading is changing over time and making plans in the middle of success for what the next level of success is going to be and what the next improvement that you can make to your trading will be. So, and I'm always in that process, and I'm going to share some of the ideas that I have about what I'm working on and what I am excited about as far as creating a smoother, and the title, excuse me one second. On the slides for the disclaimer, I should have disclaimed that I have a voice problem this week, so I'll be taking little breaks for drinking some hot tea. But anyways, so I look forward to sharing some of the ideas that I'm looking to implement for, and as the title said for the presentation, a smoother equity curve. What I've been, over the last couple of weeks, I think I shared that title with Tom about a month ago, but the theme that I'm working toward in my research and implementation is a smoother and steeper equity curve. I can show you in about 20 minutes how to create a very smooth equity curve. Actually, I could show you the smoothest equity curve on Earth at this point in time is the yield from owning long-term bonds or parking your money in a money market account. So smoothness is not difficult to achieve because it's often related to risk. If you just eliminate risk, you can eliminate volatility and create smoothness. The real goal should be to steepen the equity curve and smoothen the equity curve. So, and I'm going to share a couple of topics related to that. My general approach to trading is not based on rule-oriented trading and campaigns. I absolutely believe and support that style of trading, and I think it is effective. It's just not the part that I've been focused on. The part that I've been focusing on is sizing, risk control, management, and on a portfolio basis, and using mixed strategies for a net effect of smooth equity curves rather than focusing on researching adjustment strategies. And that's simply not because I am convinced that that is a better way to go. It's just a different way to go, and we only have time in the day for researching a certain number of ideas. So the one I've been more focused on is using a portfolio approach. So around risk control, or really my methodology and my approach to trading is that I use a routine of objective market analysis rather than a set of rules or a set of campaigns in the trading. So if I'm experimenting, if I'm trading discretionary, whatever aspect to the trading is being implemented at the time, if I'm going to change systems, if I'm going to add a system or add a trade or add a rule, all of it has to be within the context of three things that I've studied, which are the value of the long-term trend, the statistics of short-term mean reversion, and then the edge of intermediate momentum. So I think I've shared in the past in capital discussions about filters for trading, and so in that presentation I get more into about the statistics behind different signals in trading, so I'm not going to cover that again. But those are three things that I'm very consistent throughout the last several years. No matter what I've done, I respect the long-term trend, and that is an objective measure of some high-level moving average on a daily chart. So I've referenced the 190 exponential, being that is the one that is generally optimized. If you just optimize every stock, ETF, index, futures market, etc., there seems to be this collection of the best results around the 190 exponential. That could just be some random event. Ultimately, anything surrounding the upper 100s and into the lower 200s on either an exponential basis or simple basis all provide value when looking at a long-term trend. So lately, I've just been kind of flipping it over to the 200-day moving average to remove some of that mystic nature of claiming that there's something valuable about the 190 exponential. So I just look at the 200-day simple, just to not give it any more credit than the fact that it's just respecting the value of the long-term trend. Short-term mean reversions would be anywhere from 10 to 20-day moving average. I've often used linear regression in the past. That is value as well. Same thing, I just want to remove the mysticism around some special indicator. It's really just the nature of short-term mean reversion. The market, most equity markets, including equities themselves, especially indexes, tend to mean revert on the short-term basis and trend on the long-term basis. And then intermediate momentum has a small edge to it. It's actually one of the least valuable edges. It's least consistent. It works on the fewest number of markets. It's seemingly random. But when you apply it to risk control of market neutral options, it does have a little bit of value to it as well. So I watch those things in managing the portfolio-based, beta-weighted risk profile of all trading. But and then anything I do inside of that, I have freedom to experiment, to try things, to try a bunch of good trades inside of that context of I'm very strict about the big picture. If we're below the 200-day moving average, I reduce size and trade generally longer-term options. If intermediate-term momentum is bullish, as it turned a few weeks ago, then I begin to reduce the amount of risk that I would experience if we trade to the upper end of Bollinger Bands and Keltner Channel on the daily chart. So these are just things that on a daily basis I observe, I discuss with the people that I trade with, and try to be very objective about those things. Then when I go into actual trade execution, which spreads am I going to pick, which indexes, which stocks, which ETFs, which markets am I going to be in, do I want to try the rhino trade that I learned about recently? Do I want to try broken wing butterflies? Within the context of my objective market analysis, I can apply any of those that I want, but it's not about overanalyzing which trade is going to be the best trade and then overanalyzing which adjustments I should make. All of those types of trades are great, and they should be applied, and they can be applied to the trading. But if you use that bigger picture filtering and objective observation of the market conditions and vary your sizing, then you can control your risk in whatever you're in. So this statement here, a bunch of good trades rather than one perfect trade. So, and I will show you mathematically how that works out with a series of back tests that were completed. But it kind of comes from Mike Bellafiore's quote from his book, One Good Trade. And this is a paraphrase, I should say. I'm adjusting the wrong PowerPoint. Here we go. A bunch of good trades rather than one perfect trade. And this really is a paraphrase from Mike Bellafiore, where he says, make one good trade, then one good trade, then another good trade. When I first read the title to his book, I actually thought it was going to be stories about how traders that were working really hard, and then one day they had that one really great trade that changed everything, where they made a bunch of money and they built up their confidence, and it was that one good trade that changed everything. And after reading the book, I learned and realized very quickly that it had nothing to do with the singularity of a single one trade. It was about every trade should just be one good trade. And a good trade can lose money. It can be a good trade because you did everything right, you controlled your risk, and your loss was the amount that you expected to lose, and it's within control. A one good trade can be a winner. Likewise, you can have a bad trade that is a winner, one where you did not have the right amount of control, and not the right amount of size, you did not follow your plan for the trade, whatever it is, it's something that would not be sustainable and repeatable. So just making one good trade after another, and I want to bring that into kind of the options world and say, well, what are good trades? I do want to go back. Yeah, a bunch of good trades rather than one perfect trade. So a good trade is one that respects the context, and that context is what I was talking about as far as very simple observations of what is the current long-term trend and what are the implications of that, as well as are we far divergent from short-term mean, and what is the implication of that. Having that context is very important as part of good trades. So reasons to not enter certain trades. John Locke has taught about the bearish butterfly is a great trade if you trade it consistently. However, if you have context in mind of not entering the trade when you are sold off, that adds value. So there's always context behind trades that you can use. Some of that you may have to use discretion or opinions on. Most of it you can quantify with some kind of statistics about very simple technical indicators, including implied volatility and trend and momentum and all that. A good trade, second point, has one or multiple edges to it. In this room, we know that, excuse me one second. Everybody in here is implementing the edge of positive theta. That is a very good edge. Most of the complex spreads that are discussed have the edge of a high theta relative to its gamma, and its risk control over a certain movement in the market. So that is a second edge. So those are great edges, and they should be exploited and experimented with and researched to continue to get the most out of them. How do we get the highest amount of premium decay with the lowest amount of directional risk in these trades. I think that is something that should be continued to be explored, and I applaud Tom and Jim and Capital Discussions and Options Tribe and Seth and John Locke for really paving the way into that style of trading and developing those edges out very thoroughly. What I'm going to be encouraging you toward in the rest of this presentation is about looking for more good trades as well that are going to be very different from those and on their own are going to be nowhere near as attractive, but they add a very high level of value to your trading. So that's what we'll get into. And that's the third point here, which is has different edges. So I'm looking for a bunch of good trades, not one perfect trade. Another good trade or something that I can add it to my collection of good trades is something that has a different edge than the edges that I already have. So another term for that is just diversification. But it's not a diversification of just a bunch of different things. It's I want different edges. If everything has an edge, and if I can quantify it, I can prove it in backtesting that there's a semi-reliable edge to that strategy, and it controls its own risk, and the outliers of drawdowns are not ridiculous, it can have a place in my portfolio. So that's a very important thing. A good trade does not react to irrelevant or one-off variables. That's kind of just a standalone statement for when you're implementing the trades, there shouldn't be some random single event that either shakes your confidence or creates some loss that you've never seen before in your studies or backtest of it. So it should be reliable, dependable, and not adjusted continuously based on new variables that show up in the market, because then you're adjusting it beyond the point of reliability, and you're just making it overly complicated, probably for psychological reasons. And then the final one is it should be implementable and scalable. Pretty simple, but scalable is very important for me, especially as I would like to trade more and more and add more accounts. And in most structures, you can just manage a single model account, and that can be diverted to multiple accounts. So that makes it easy to implement a lot of different trades. But as far as scalability is making sure that this liquidity and the execution can be repeated if you add 1 or 2 zeros or 3 zeros to the end of the trades. So scalable also should be, as you add more and more trades, it should not prevent you from implementing the system as well by being too many adjustments or too many trades to handle on your own. So what is a perfect trade? So I'm saying I want a bunch of good trades, but I don't necessarily want a bunch of perfect trades. And that's really, the term perfect is something that means there's nothing wrong with it. And I don't think that's ever going to be achieved because there's always going to be downside to trading. And so I do not want to pursue perfection for a single strategy or a very highly correlated set of strategies. I am focusing my work on adding more good trades rather than perfecting systems that will always have downside. And every single strategy and development, or every single strategy or approach that I add to trading is going to have its own downsides. And then even the process of diversifying into all of those strategies will have its own downside. So there's always going to be downsides. I'm just trying to limit them on an individual basis and help them work together so that I have a good, smooth equity curve. And I'm going to show you an example of a back test that demonstrates these points, hopefully very clearly. So a perfect trade would be one that's over-optimized, and the more you optimize, the less reliable trades can become, because if you add too many variables to the history of a trade and you allow it to pick from too many conditions, it's just going to find the one that happened to avoid the worst trades and get into the best trades, and that is not a non-reliable way to pick the best trade and call it perfect. Or attempting to make one style of trading or like a square peg fitting into every hole. So trying to make it fit a square hole and a round hole and a triangle hole and an oval hole. Or another term for that would be trying to make it all weather. So market neutral trades are going to have conditions that are going to be challenging and will generate losses, or at least going to be more difficult to manage for an extended period of time. And we are in one of those times, generally speaking, where a lot of market neutral trades are under pressure, or even market neutral traders that either made poor decisions or over-adjusted or did not make the necessary adjustments based on backtesting. Whatever it was, the implementation of those trades has them under pressure. Last August and this past January being specific examples of that. So this slide should have been up near the top, but this is some statistics about the 200-day moving average and why I use it. Since 1960, we have almost 14,000 days or sessions to look at, so it's a very large data sample. 69% of history has been above the 200-day moving average. So that's the nature of slower moving, consistent bullish trends and then fast, short duration bear markets. So we don't have backtesting data for options going back that far. I'm not even sure what the options market looked like in the 1960s. But if we're trading things that are statistically oriented, meaning you're basing your decisions on market neutral trades around what typically happens and what is normal distribution in the market, it's important to remember that the market is normally above the 200-day moving average. And the rest of the breakdown here shows, I think I got the little drawing thing here. Looks like it's going to be purple. So, so these two go together. Oops, it's not working.
If you're in PowerPoint, doesn't the P key bring up the pen?
Well, I see the tool, and it's actually floating on the screen. It's just not actually, it's not writing. So I'll just skip it.
Try Control P. That might give, if you're in PowerPoint.
I got a line now.
That's better.
Got it.
Control E. Okay, good.
Control P did the trick. Thank you.
And Control E erases.
So these two are connected together. Let's see if I can. Yeah. So average daily move since 1960 is the average move in the market is 0.03%. So if you just take the percent change of every single day since 1960, it just comes out at slightly above break even over time. But when you take the average, I'm sorry, so these three are looped together here. If you take the average daily move above the 200-day moving average, it nearly triples to 0.8. Still a small move over average, but if you take the average daily move below the 200-day moving average, it actually turns into a negative, and a bigger negative than either of the positives for all data together and above the 200-day moving average. So there's a slight edge in, very slight edge in the bearish delta being slightly negative delta below the 200-day moving average, but other studies that I don't have the data on in this presentation, the mean reversion and the total range of the market is so much larger that just having a constant negative bias below the 200-day moving average is actually more dangerous. So it's actually just better to reduce overall exposure. And that's what the next few, learning how to use this little tool here, that's what these tell you here, is that the daily standard deviation move, that's not a one standard deviation, that's just of all the daily moves, what is a one standard deviation as far as a percent basis? Overall, the market moves about 1% per day is a 1 standard deviation move. Above the 200-day moving average, it reduces to 0.77, and below, it actually is double what it is above. So, and we have experienced that lately. The 200-day moving average is not just a filter to say now you should be short. The actual greater edge to know and take advantage of is that below the 200-day moving average is a time to reduce exposure, either widen out your spreads or reduce size or move to later dated options that have a bigger break-even range, or at least a wider range of low gamma. So that is something that in my trading, let's see if I can just, is it Control P to shut it off to you?
I think it's just the letter E erases all the on-screen stuff.
E. Oh, I can hit X. There we go. So, so this equity curve here of my history, the voice is going. So here's last August, basically a small drawdown during a point in the time, very high volatility in the market, and then all throughout January, the market had very large movements. I don't want to just say a correction because that was only half of the movement. As we know, the bounce was just as severe as the decline. So that is the nature of being under the 200-day moving average, is that the market, which I think I did have that. Discard. Yeah, I don't have the 200-day moving average on here, but it's basically has been following something like this here, and I could probably just add it real quick. Well, I was close. So here is last August. We closed below the 200-day moving average, had a very fast correction, and then a very fast bounce. Back above the 200 is lower volatility, a little head fake below, and then the second move below the 200-day moving average with a big spike back up. So it's really about the size of the movements below the 200-day moving average more than it is about the actual trend of the moving average. Back to the presentation. So those two time frames I highlighted are here and here on the equity curve because I reduced exposure during that time. Here we go. Okay, so here's some more data that helps support the concept behind this. This is, I forgot the number now, A, B, C, D, E, F, G, H, I, J, K, L. 12, I think it's 12 systems are shown here. And you can see down at the bottom, you can see the mouse moving, right?
Yeah, sure can.
So you see, I left 2 in here that are pretty terrible, just to demonstrate, you know, I'm not going to handpick only the best ones. I'm just picking 12 strategies that I've heard of that I thought had value to them, and 2 of them pretty much had no value to them. But I left them on anyways just to prove the point that it's not about picking a bunch of great strategies, but it's really just about a bunch of good strategies. So you can look through this and see that there's a lot of equity curves, and these are all back-tested systems, 100% rule-based, very some of them have adjustments, some of them don't have adjustments, some use filters, some don't use filters, but they're very typical types of trades that each one of these equity curves you could do a series of webinars on and show, here's what the trades look like, here are the adjustment rules, this is the decision points that you would make, this is why you would make them, here's what the delta and theta look like, here's what the profile looks like when you get in, here's the adjustment, here's how you get out. Every one of these lines is representing a system like that, but actually playing out over time. And we have, it's not a huge history because we're not gathering much more than the proof of the portfolio basis here, is that we have about a 6-year track record for anything that had data. Some of the weekly strategies aren't implemented until late August or late 2011 or 2012 when the weeklies were available on a regular basis. Or some instruments, weeklies weren't available to then at all. Some of these are bearish strategies, some are bullish, some are neutral, some are high probability, some are low, actually inverse of high probability, where less than half of them make money, but the wins are big. So it's this big collection of good trades. Very few of them are attractive on their own. The one that I think is most attractive on its own is, use Tom's new trick here, Control P, would be this nice kind of dark red line. That's probably one of the most attractive ones on its own. And maybe you know this, Tom. Who who would we give credit to for the parking trade?
Tim Pearson.
All right. Is Tim here today by any chance?
He might be. Let me look. Tim. No, he's not here.
Okay. Well, maybe if he watches the recording or somebody talks to him, that he can be congratulated for his back test coming out to be one of the most attractive ones in this study here. The orange line is a weekly bearish butterfly, actually. Kind of a unique trade that I did not think was going to work very well, just because of the low, what seemed like a low probability trade and a lot of gamma problems, but actually did well. This, which one is it? This green line is a short put strategy that actually is a short put weekly, but it uses a deep in the money contract. So you're selling I think it's an 80 delta with 2 weeks to expiration. So it's intended to be a bullish hedge with intrinsic value that you're selling and a little bit of theta decay to it. So that was intended to be a bullish hedging trade. And then there's a whole bunch of other stuff in here. This was selling a short call, this yellow one. So selling an out of the money call with a lot of time to expiration and then rolling it every month. That was pretty pointless. And I have a list somewhere that I can go over all these, but you can see they're all good. The parking trade is probably the best one by itself, but you can see there's a lot of times based on the rules of it that it's flat. So this entire period of time here, which is about 5 months or so, you're not trading the system, it's flat. Same thing here, that one there, here's a flat period, here's a flat period, and here the data just ended. That's where the test ended, and just some time has come in since then. So it's got that to it. I also believe the intra-trade drawdowns can be a little bit larger and they're not represented. So you may just be holding a trade that experiences some drawdown, but the end conclusion of the trade is positive. So that's the data point that we see here. So it too is not a perfect trade because it has its own limitations as well, but it's thrown into the mix here. Anyway, so let's try E. All right, Tom, pitch me PowerPoint.
Robert said that Dave Thomas is actually the creator, but I know Dave and Tim are good friends, and Tim just helped flesh it out. And
all right,
Rich,
is Dave
Rich
here
also
then?
asked, are you generating these curves automatically or through manual back testing?
I had the benefit of working with David Wilt, who was he the co-inventor, is that what you would call him, of Quanti Carlo?
Yeah, co-founder.
Co-founder, okay. So these were generated by, actually 2 of them were done manually, and the rest were done by computer simulation. So programming the back test to come out. All right, so E, down arrow. This is, if you take, I did drop out the short call strategy. I thought that was just completely useless. So I took that one out, and I think there was 1 or 2 other ones I took out because I don't think they're just very cumbersome to implement. So I removed them even though they were fine. On a theoretical basis, I think implementing them would be more challenging, so I did remove those. So what remained, though, is this combination here. Let me think. 1, 2, 3, 4, 5, 6, 7. Yeah, okay. Just making sure. Saying the right thing.
And
a little bit.
Just real quick, Rich asked which ones were manually done. Do you know?
A portfolio of short put spreads on individual stocks and indexes was done manually, and that was a momentum and 200-day moving average filter. So it's not a market neutral trade. I guess that's another point I should make is some of these are market neutral, some are bearish, some are bullish. So just that mix of trades that perform at different times, have seemingly random correlation of when they do better than other times. You can have two bullish trades that have a great period of time. One does, and then the other one's not doing very well. So they're just not, especially if you use the momentum filter on the bullish trade. That one helps out too. And I think I can't remember. I think that's this light blue line. This one here is the short put spreads on momentum stocks. Pretty sure that's what that one is. Because it was 2013. Yeah, there was a huge run up in that in 2013 because the market was very strong. And then near the end here, the market wasn't as strong, so it turned flat. So that's what that one is. And then another manual one was the short call that was out of the money. The yellow one here. And I think there was one other one, but I can't remember off the top of my head. So here is, if you take a bunch of good trades that each equity curve is positive, has a positive drift to it, and does well, but I would call it not attractive. I think each of these is pretty volatile, not very amazing. There's enough people in here that if you all looked at these and you said, which of these equity curves represents you the best, you could probably point at one of these. And there might be a few of you that need one that goes a little bit deeper to the negative side every once in a while. But for the most part, you can see that this is the experience of a lot of trades that have edge to them. They are positive. You expect to be profitable over time with each of these. But by mixing in a bunch of them together, rather than trying to, for example, I could say this orange equity curve of the butterfly is very, very attractive. So I don't have to say that I'm going to pick that strategy out and figure out how to get rid of the drawdowns and make it better. That would be what I'm saying I don't want to try to pursue. I don't want to try to perfect a single trade. I would rather go out and find another good trade to delegate some of the portfolio and some of the assets to. And that can be done a number of different ways, but really what you're looking for is just anything that has edge and a different edge than what you are currently trading. I'm going to do another sip break here. So this is what I'm basically working toward. This is what I feel is the next level of improvement in my personal trading. I have positive results. I do not have big drawdowns. I'm glad and fortunate for that, and I work hard. But I feel like I'm far from where I could be and what the opportunity is in market neutral options trading. I am market neutral. However, I believe that the best way to be market neutral is to implement a lot of directional trades inside of your portfolio in small size. Those are, you could call them hedges, but they should on their own have positive expectancy and expect to do well when the market goes up and not as poorly when the market goes down. That's how you have edge. Just when you win, it outperforms when it loses. And that was demonstrated here by that. This is a very bullish strategy that even when the market is bearish, like this, see the dates here. So this time here, the market was very bearish, but there was still a lot of things that worked well. It just took fewer positions. It only took good positions because it uses the 200-day moving average as a filter. There have been a lot of stocks and indexes that remained above the 200-day moving average for most of this year so far. So there's plenty of opportunities on the bullish side if you go out and look for different things to trade. If you are always looking for ways to be bullish, bearish, and neutral in just the index, I believe that is actually more challenging. It's actually easier to go out and find stronger relative strength instruments, get a whole basket of them, and trade a system of bullish trades on those, and pair that with your neutral and bearish index trades, and the net result can potentially be something more like this. So this is kind of the more of an ideal that I'm working toward. I'm implementing things like this. I'm implementing a higher diversity of trades. I trade tons of stuff, probably 60 or 80 different stocks over the last year, most of them being options trades on those, a lot of futures trades. I'm starting to get into volatility-based ETNs, also known as ETFs, because they have a very different type of edge to them as well, and they are semi-correlated to the indexes. So I'm starting to implement some of those as well, and I don't think I have any, no, none of those were in this, actually letter L was, I don't think it was in this last one. Yeah, this one actually was, I'm sorry. This line here is a UVIXY trade, actually negative theta trade that did pretty well, considering how simple it was in the first version. All right, so here are my tips for if you're interested in this style of portfolio development and adding a bunch of good trades. This is how it could look if you're early on in that and you're not implementing a lot of that. The three keywords, I usually don't try to do PowerPoints with covered in text, but that's what we got here today. These are the three keywords to make sure you're working on. Do you have things that are neutral? Do you have things that are bearish? And do you have things that are bullish? Examples of neutral trades would be all of these. M3, road trip trade, Weirdor, Rhino. I didn't mean to leave anybody else off, but these are ones that come to mind as very well studied, lots of documentation about it, things that you don't have to go reinvent the wheel, and you can just learn these trades and probably have positive expectancy on, especially in neutral markets and sideways moving markets. Then you should have something that's bearish. And something I should emphasize is not when you feel bearish, but at all times, based on its own statistics, based on what is best to have as a permanent fixture in your trading. Adding bearish trades after bearish moves is not a way to have a respect for the three-way moves of the market, which is up, down, and sideways, but having a permanent fixture for that. Bearish butterfly is an excellent bearish one. A couple that aren't really discussed, VIX on dips, so that's something that I've done for a while in small size that I'm going to be adding, is buying VIX calls when the VIX is in lower range. So if you apply Bollinger Bands, Keltner channels of all different time frames, the further we are in the lower end of those channels, adding VIX calls, in the money, out of the money, at the money, they all seem to do well. That's a study that I've yet to perform on optimizing, but I have had profits, generally speaking, well, not generally speaking, I have been profitable doing that from a discretionary basis, and I have yet to study, though, on making it more systematic. But buying VIX after the VIX has gone down a bunch works. Also being consistently short VXX and UVIXY, that was a good back test as well that I've begun implementing in the last couple of weeks and months. Another one is a call ratio spread. Does anybody talk about that? Have you had presentations on that?
Not really. It's a good trade, though.
Yeah, it's a great trade. So the call ratio spread, you can study that. A way to do it, though, that has less margin requirement and ultimately less risk on an absolute basis would be to turn it into a broken wing butterfly. So this is a trade where you basically have no downside risk when you structure it correctly, mathematically speaking, unless you make poor decisions or execute incorrectly. There is no downside risk, positive theta, and a little bit of negative delta to it. However, it does quite well even in bullish markets. So it's a great trade that you could consider as well, adding to your mix of things to study. And then bullish trades. even though options traders on a collective basis are probably the most bearish citizens of the world, it's never ceases to amaze me how bearish active traders are, regardless of what's happening. The market could be making new highs, and they're bearish. It could be crashing, and they're bearish. It could be going sideways, and they're bearish. There could be headlines that are good, they're bearish. Headlines that are bad, they're bearish. So this constant bearish. So if you're struggling in your trading during bull markets, just if we're in a bull market, we've crossed back above the 200-day moving average. Volatility is settling down. There is a very low probability on a statistical basis that we won't trade back below the 200 moving average soon. But on a risk-reward basis, you are insane if you do not make adjustments to your trading that respect the fact that we're above the 200-day moving average, because even though it's a low probability that a single cross of the 200-day moving average will hold for a long period of time, or in the short term, when it does hold, you can be on the wrong side of the market if you're not bullish, or at least having bullish components to your trading. You can be on the wrong side of the market for several years, and that's not something that would be advisable. So bullish trades are short UVXY, which is hard to borrow. So long puts, negative theta, long puts on UVXY is a great upside hedge for market neutral trades. There's positive expectancy to it. It's been back tested. Even as a negative theta trade, seems to do okay. I'm researching some neutral theta or even positive theta trades on those as well, but hopefully in a future presentation I can share that with you. Long traditional stuff. I was getting less creative here. This is your typical buy and hold index, traditional 401k type investments. If you have a little bit of that, then you have a little bit more reason to have bearish active trades on, because now you have something to hedge. But those are things that obviously benefit from the nature of the market, the fact that we're in the greatest country in the world. Sorry, Tom. And was that did you get that? Okay.
I did, yeah.
Yeah, okay, good. So we're in America. We have the greatest companies in the world doing the most amazing things, and they're all listed on this exchange where you can own their stock. And to be permanently bearish on that is a very dangerous outlook, because you're picking the strongest of the strong and saying that they are likely to decline for some political or personal reason, or whatever your reason is to be permanently bearish. It doesn't matter what you think about the fundamentals of the country are. To have a long-term position of short America is a pretty terrible plan. If you really believe things are that bad, you're probably better off owning gold or trading bearish butterflies than you are to just be outright short equities. So being long the traditional stuff has its advantages. You can collect dividends and reinvest them. You can have long-term capital gains rather than short-term trading. There's a lot of benefits to that. All that said, full disclaimer, I do not have any of that. Everything I do is options trades. But there is value to that if you have those positions. That is something you can do to be bullish. And then short puts with filters and also put spreads. That was one of the tests I showed you that was very effective. Only selling puts above the 200-day moving average, only selling them when momentum is positive seems to have good edge to it. I think it reduced the total return, but it greatly, even more so, reduced drawdown. And I think that's what's more important. So positive momentum and above the 200-day moving average is a great bullish trade. Hey, that's it.
Hey, I remember Charles Cottle mentioned in a portfolio he likes to have 10 pieces, 3 neutral, 3 leaning long, 3 leaning short, and 1 spec trade. And that kind of goes in with your tips here for spreading out having a combination of neutral, bearish, and bullish in your portfolio. Absolutely.
And one thing I want to bring up too is I'll just kind of admit that I was wrong about something that's very important to do. I used to think time diversification didn't have much value. So spreading out, doing the same trade in 3 different expirations at the same time. I think, well, no, that's not really diversification. It's the same trade. It has the same fundamental risk to it. That came back from back testing and studying to be not true, and there actually is a great amount of diversification in doing the same trade in different expirations. So there's so many levels of diversification that you can do, and like you said, you can just, if nothing else, just either 3 different trades, 1 bullish, neutral, and bearish, 2 of each, 3 of each. That is a great place to try to work toward to help you add consistency. Plus, when you have a bunch of trades on, some have the objection that that becomes more difficult to manage. Well, I'm not looking for perfect trades that have a lot of management rules. These are very, very simple trades, 90% of which are not touched any more frequently than once a week. Some of the trades in there, you literally did not have any type of adjustment to make other than once a month in that collection this one here. Some of these once a month trades, once a week trades, very, very simple trades. Only a few of them would you have management points during the week. So you can implement 10 different systems if they all have low thresholds or low frequency for adjustments. So it's not difficult to diversify if you keep the trades simple. And you can trade multiple expirations, multiple trades, bullish, bearish, and neutral. That's a great first step. And then long term, where I think the smoothness greatly increases and your steepness can increase is when you get outside of the indexes as well. And you start moving into individual names, multiple indexes, ETFs, individual names, ETNs, futures, etc. When you start mixing in different underlyings with different trades, that's where I think the diversification really starts to take hold. And you can start to see something that might look like this over time, or even better.
Hey, Andrew, I have a tool on Capital Discussions, a trade simulator, that actually illustrates this pretty well. If you don't mind, I can just share my screen for a minute and show it.
Yeah.
Okay. Okay, here we go. Let me know when you can see the screen.
It's loading, and it's up.
Okay, so to find this, you go to Tools and then Trade Simulator. So I've got basically, if you do one trial, that's one set of trades, and in this case, it's 150 simulated trades. It just uses random number generators. It generates a win percentage from whatever your 2 variables are here, and the losses are here, win percent, etc. And you can see it's kind of jaggy, and this is a trick from Joe Ross, by the way. You have a moving average in your equity growth, and if the actual equity goes below this moving average, you go to paper, and when it goes back above, you go back live. So that's one thing Joe does. But you can see it's kind of a jagged equity growth, and if you just do another test, you know, sometimes they're smooth, sometimes they're not. Like this one wouldn't be too bad. But if you do multiple trials, like say you do 15 different trades of 150, then it shows the envelope of the best case of all those 15 and the worst case. So some of them were negative. Yeah. You can see overall, as you combine different trading systems, the growth is very, very smooth.
Yes. So this is awesome. I wish I had known you had built this, because I spent way too long doing this in Excel. But I think if you're watching this and your eyes are glazing over because you were hoping to find an options trade and a list of rules and a PowerPoint you could download that would let you follow along and have a profitable trade, I think what's currently on your screen now is probably the most important takeaway as far as a visual that says a small amount of edge is all you need. You don't need to reverse engineer and make one trade. You look at all the trades you've heard about and you say, which one is the one that I'm going to focus on? And then you pour your heart and soul into that one and try to make it the best one ever and never lose, or at least have tiny losses and win 90% of the time. You're better off, I think, my opinion, picking a whole mix of trades, not restricting yourself or constricting yourself to having these very frequent adjustments and very detailed analysis that you have to make of those trades. keep them simple, a little bit of positive edge in each one of them, plus the random nature that Tom just demonstrated, as a collective group of positive edges, always tends to net out. Always tends to, is that even a phrase? Tends to net out to a very smooth net result. And that, I think, is the pursuit that is going to lead to more consistency, less requirement on gut feeling and discretionary decision points, just by finding simple edges and implementing as many of them as you can handle in a way that lets them all randomly work on their own and then collectively work together.
Right. And I guess before we wrap it up, because we're running out of time, did you want to talk about the trading contest?
Yes, I'll briefly mention there's not really a lot you can see at the moment because we are updating the page, but on optionstribe.com there's going to be the information about the options trading competition. So if you participated or followed along last year, you'll already know the best way for you to just stay in touch about that. There's two things. You can either participate in it or you can actually just monitor it and see how people are doing in the trading competition. So it's a market neutral trading competition that lasts 6 months. It begins April 1st. The easiest thing to do is just to follow along or participate. You do have to be a member of Options Tribe, the paid membership. So it's just a 6-month paid membership to optionstribe.com, and then you'll have all the information you need to be a part of that. If you just want to learn more about it, then you just do the free membership, and then you'll get the email announcements about it.
And Rich also pointed out the simple portfolio theory says approximately 15 instruments provides the best level of consistency. More than 15 provides diminishing returns. So yeah, that's consistent with portfolio theory.
Awesome. Yep, that makes sense.
All right, so thanks very much for the great presentation, Andrew. Always a pleasure to have you on. I'm sure we'll have you back in the future.
Great.
And everybody who's interested in the trading competition, check out optionstribe.com and sign up if you're not a member and join the contest. I guess it starts pretty soon, April 1st or thereabouts.
Yes.
So you still have a few more days, but should start in about a week, so plenty of time to get signed up and ready.
All right, awesome.
Okay, well, thanks everyone for joining, and we'll see you next time. Thanks, Andrew.
Thank you. Bye.
All right, take care. Bye.